Hi founders, my name is Kushal and welcome to a new episode of Know Your Term Sheet. This is a series of videos where I help demystify standard VC term sheets for first time founders like you so that you know what you're signing up for. If you have been liking the content that we have been putting out, please do hit those like and subscribe buttons so that we can reach out to even more founders who might benefit from this series. Today we will be discussing another standard term in the VC term sheet, which is the ESOP clause. ESOP stands for Employee Stock Ownership Plans. Now ESOPs are basically a way for you to share the wealth creation journey of your company along with core team members who join early on in your journey. People who join you early on, they take on significant risk along with you, right? Because this company might not work out and might very well fail. So they take on significant career risk and they sometimes also take on pay cuts. Giving these team members ESOPs is a way to basically give them a share in your business such that if this company does do well, they also will benefit from the company's future success and they will make money apart from the salary that you paid them. Now we will delve into how to structure ESOPs, whom to give and whom to not give ESOPs, how they work for startup employees in a future video. In this video, we will cover ESOPs from the perspective of the VC and the term sheet and what should you expect in the term sheet. For a majority of startups, ESOPs is the founder's most effective weapon when it comes to attracting good quality talent. Think about it. Why should an engineer who's been working at Flipkart or Amazon or Google and earning 30 lakh plus a year leave their nice job at this nice company and come and work for you for a company which may not survive the year and at a lower salary, right? Why wouldn't they do that? It isn't even their company after all. Well, apart from the fact that they admire you or they like your vision or they admire what the company is building, financially speaking, the only answer is ESOPs. Top quality talent will not come and work at your company unless you can compensate them at least in the long term like their top quality talent, and the only way to do that is with ESOPs. ESOPs give your employees a chance to participate in the wealth creation journey of the company. Multiple Indian startups now like Flipkart, Razorpay, Meesho, Urban Company and many others have bought back ESOPs at a very high price from employees at later rounds. Either the company has bought these ESOPs back or new investors coming in these companies have bought ESOPs from the employees, and hence these companies have now created a lot of wealth for many employees who joined them early on, and multiple people in the ecosystem have benefited from this, right? Now the smart talent in the ecosystem has seen this and knows this and understands this, and hence they will expect to have a significant portion of their compensation package in the form of ESOPs. Every investor also knows this and hence wants the company to have at least a 10% ESOP pool and sometimes even more, so that the founder can use it to incentivize and attract the best talent to come and work for the company. Now what do we mean by a 10% ESOP pool? It means that 10% of the company's total shares are being set aside for an ESOP pool which can be given to individual employees. Now let's take an example. Let's say you and your co-founder each own 50% of the company and you raise money from an investor who takes 20% stake in the company and they give you $2 million at a $10 million valuation, right? A smart investor will make you create an ESOP pool such that after the round closes, the cap table will look something like this, where the investor ends up with 20% like they promised, but you end up with 70% and not 80% because there's a 10% pool being carved out for employees who come and join the company later on. So the ESOP tape, the cap table looks something like this, with 20% going to the investor, 70% to the founders and 10% to the ESOP pool. Now this effectively means that the ESOP pool got created from the founder's equity and not the investor's shares, right? Now from the investor's point of view, they want to own a minimum percentage of the business. So if they offered you a 2 million on a 10 million valuation and you create a 10% ESOP pool after the round, it means that they want to own 20% of the company after the round, right? Now if you created the ESOP pool after the round closes, right, and you ended up diluting the founders and the investors, then the investors will end up with only 18% of the company because even their 20% gets diluted by 10% that you create for the ESOP pool. From the founder's point of view, the ESOP pool is being used after the round, right? Like after the money comes in, that is when you start hiring people, and this ESOP pool will be put to work to benefit everybody in the company, which is the founders, the investors and the employees. So shouldn't the investors be also diluting their stakes for the ESOP pool? To be honest, both arguments are valid. What is important is that you as a founder, you are aware of what you are signing up for. You should understand that a 10% ESOP pool non-dilutive to the investor means that you will end up with 35% of the business and not 40% because there's an extra equity being given to the ESOP pool and the investor will still end up with the 20% that they asked for. And if it's not that scenario or it's a scenario where you are issuing the ESOP pool after the round closes, then you should understand that you will end up with 36% of the business, the investor will end up with 18% of the business and everybody gets diluted. It's important to understand both these scenarios, understand what the investor is talking about and negotiate accordingly on the valuation, the raise and the dilution. Also, this 10% number is not ironclad. Some companies do go with 5% pool if the founders feel that they don't see them hiring very senior level people early on in the journey of the company. I have also seen some companies go as high as a 30% pool because the founders feel that they need to hire a lot of senior people. The bigger the pool, obviously the more you have to offer to prospective employees, but it also means more dilution for you and maybe also the investors. So this is a call that you have to take as a founder. If you have raised a lot of cash, let's say you have 5 million in the bank, 10 million in the bank, then you can pay people above market salaries and there's no need to give them extra compensation in form of an ESOP pool. But if you have less cash, then you will have to give a prospective employees, you'll have to compensate them with ESOPs. However, it is advisable to give everybody in your core team a significant amount in ESOPs so that they not only join you but are also retained and work with you for many years, as they will also enjoy the upside of the company's growth. The ESOP pool is also something that you can keep adding to, right? So in every round, you can keep on increasing the ESOP pool if you have already given a percentage of it away to employees. So you could start with a 10% pool and then series A you could go to 15%, series B you could go to 20%. That's all up to you and the investor and negotiations you have with them. So to summarize, ESOPs are important to attract and retain talent. Just figure out whose equity is going to create the ESOPs. Is it going to come from only the founders or is it going to come from both the founders and the investors? Both approaches are fair as long as you know what you're signing up for. And 3, I recommend having at least a 10% ESOP pool and then you can add to it as the company grows, but 10% is a bare minimum. Having no ESOP pool signals to the market that I don't want to hire smart people. That's it for this one, folks. If you have any questions or if you have a different point of view or if you felt I said something wrong, please do write to us in the comments below. And don't forget to like and subscribe if you have been liking the content so that we can reach out to even more founders. Keep building, keep hustling. Cheers.